Welcome back. You're still tuned into Commodity Central right here on ET Now. And after having discussed the various types of commodities, risks involved in commodity trading, and the ways and means of investing in commodities over the last few weekly edition episodes of Commodity Classroom, today we will put the spotlight on historic returns commodities have given versus other asset classes. And to discuss all this and more in greater detail, we now have Mr. Kunal Shah, Head of Commodities Research at Nirmal Bang Institutional Equities, now joining us. Mr. Shah, thank you so much for taking your time out and speaking with us here on ET Now. And first up, help us understand how have returns of commodities as an asset class fared versus other asset classes. And since commodities include diverse subcategories, let us first talk about precious metals. Gold and silver in particular, they have given phenomenal returns in calendar year 2024. How have precious metal returns historically been versus other asset classes, especially versus equities?
Okay, so if I start by year 2000 and we talk about last 2.5 decades, what has happened in gold. So the journey of gold started from, as low as $300, I remember. So it was my early days. I've spent 20 years in this markets, and from there, gold has risen and right now trading somewhere at 2620, and it made a high of $2,700, $2,800. So it's been a phenomenal return, 15% CAGR growth. That is what gold has delivered over last 25 years. And if you put across that, why one of the major stories. So after the 2008 crisis, the world is never the same. There has been a major monetary debasement going on in the world. 2008 crisis, 2020 COVID crisis, and ever since then, there has been so much uncertainties in the world, so much of monetary debasement taking place across the world. Japan has been on a printing spree from last 3 decades. US, Europe, UK, all these developed nations have been printing money to overcome some of the other crises. And that has led to a massive monetary debasement followed by war. But the fact remains, gold has given extraordinary return considering it as a dead investment. So if you invest in equity, you get dividends in stocks, but gold doesn't give you any dividends. Considering all of these, they term it as a dead assets, but then too it has given a phenomenal return. So whatever we've learned centuries back, gold was used as a currency. So the same role gold has played over last couple of years. And after the COVID crisis, there has been a rise in gold investment as a strategic investment more than the traditional investment. So lot of people, lot of investors, lot of central banks, everyone is now started to view gold as a strategic investment to diversify their wealth rather than just a normal investment. So silver and gold both, like you rightly pointed out, have given a phenomenal return, especially in last 3 to 4 years, last 2 years, last 1 year. 15% is the average return what gold has given in last 25 years. So still strong, going strong, and expected to remain strong.
Going strong and expected to remain strong as far as returns are concerned. That's the word coming in. But Mr. Shah, if you can break this for us into normal period versus crisis period, how has gold proven to be a good hedge in times of economics uncertainty and political turmoil historically?
It's a very good question. So, what is normal period? The normal period is anything before 2008 was a normal period. So even at that time, the inflation, the robust growth, that has resulted in a good growth of year 2005, 6, 7. We've seen gold rising up by 15, 14, 15% even at that point of time. But the things change after the great financial crisis, subprime crisis followed by the Lehman Brothers bust. From that point, the world is never the same. All the traditional economic theories are failing because the central banks are printing money like there is no tomorrow. In 2008, US balance sheet was not even $500 billion. But after the Lehman Brothers crisis, US balance sheet swelled to $1.5 trillion. Till 2020, it was $4.5 trillion, $4.5 trillion. And from 2020 to 2021, the balance sheet swelled from US balance sheet swelled from $4.5 trillion to $9 trillion. So in the history of the financial market, this kind of monetary printing have not taken place in the history of last 100 years. and that is one of the reasons why such massive amount of monetary debasement have led to a rise in the asset class like gold. Second point, everything changed after Russia-Ukraine war. So the moment Russia attacked Ukraine, their $400 billion of foreign exchange reserve was freezed by US, and some of the largest Russian banks were out from the SWIFT system. So that made a paradigm shift in gold, where all the central banks, started to think that what if tomorrow our reserves are getting sanctioned? So suddenly there has been a major shift in gold holdings. So from 2010 till 2020, every year on an average, central banks were buying 300 to 400 tons of gold. But from 2020 to 2024, central banks are buying 1,000 tons of gold every year on an average. 700-ton rise in gold buying on an average by central bank is a phenomenal thing. No central bank in the world is buying US Treasury. So the trend before the crisis was from the year 1998 till the year 2011-12, every year some of the other central banks were diversifying their reserve into the US bonds. But now nobody is buying US bonds except the US government when they were printing. And uh, all the central banks at the entire East, I mean, India, Russia, China, Brazil, Africa, uh, all the Asian countries, China, they all are buying gold. And all the West is buying Bitcoin now. But the power, there is a shift of power. BRICS accounts for the 28% of the GDP, and each and every BRICS nation is buying gold. So this has led to this kind of significant importance of gold in the portfolio of central banks, in the portfolio of investors, in the portfolio of the retailers, that this kind of return, till the time we see any solution of this huge debt built by the Western central banks, huge balance sheet which is being developed so far. So gold is conservatively going to give you 10 to 15% return in times to come
Understood.
for the period till people again go back to US bond or something else. So right now, with so much debt, so the global debt swells around public, private, and everything is $321 trillion right
Understood.
now. So with so much debt, anything wrong can happen. What is your hedge? What is your insurance? Gold. That is the only insurance. What if US dollar crash by 20% going forward? What is your hedge? Gold. So I believe the question which you are pointing, the strategic importance of gold has risen over last 20 years, and in years to come, it is going to be more critical investment, even what it was before. So right now, 10 minutes back, I was reading news. Mr. Biden, before he leaves the office, he wants to put more sanction on Russia. So there's no trust, there's a protectionism going on in the world rather than the free trade. So everyone wants to save their own economy, everyone wants to think about their own benefits. So the global trade may derail and things can go really haywire. It's an uncharted territory. 2025, 26, you don't know what's going to happen. So have gold in your portfolio as an insurance. If something goes wrong, you have gold.
Gold in your portfolio as an insurance, that's the word coming in. But shifting focus from precious metals to other subcategories of commodities, say crude oil, natural gas, or other industrial metals, how have their returns historically been versus other asset classes?
Yeah, so first talking about the industrial metals, okay, it's very interesting because ever since the China started to grow from 2000, from the year 2000 till 2012, 2014, at that time China was coming up with a double-digit growth rate. So we were astonished by the India's 8% growth rate, but China produced double-digit growth rate for almost 2 decades, okay, before it slowed down. So the size of the Chinese economy stands today roughly at $20 trillion. The size of US economy stands at around $30 trillion, 28, $30 trillion. And India economy size stands at 3.7, $3.8 trillion. But uh, the rise of China, the rise of Chinese real estate, the rise of China's infrastructure have led to a massive boom in the years of expansion of China. But then so much debt was created in the China, so much inventories were created in China. From last 4 years, China is going through a sharpest slowdown in the real estate market. The China's real estate market accounts for the 28% of the Chinese GDP, and that is being slowing down. So industrial metals in last couple of years didn't give great returns. Every time there was announcement of some stimulus or the rate cuts, at that time the metal used to bounce, and they again then again there has been going down. But now this year, the year 2025, I think is going to be a very, very interesting year for industrial metals, as in order to tackle the slowdown, in order to revive the growth, and in order to in this economic war of US and China, we believe that the strategic importance of metal will increase drastically, because China has clearly shown their intention that they are okay with the glut within the domestic market, but they want to create shortages in the international market. They have cut the export duty rebates for the exporters of metal. That is a clear intention that they want to create shortage in the market. They are going to come up with 100 basis point of RRR cut. They are going to come with the massive stimulus of $1.5 trillion in order to revive their economy. But they are waiting for what Mr. Trump is doing with them on 20th of January. So the moment they see a clarity, I believe that China is going to go left, right, center and give a massive stimulus in the economy. So this is the year of industrial metals. I'm very optimistic about the overall outlook of metals and metal stocks going forward. And I believe that with the bouts of volatility in the first quarter of 2025, we are going to see a sharp rise later during the second or third quarter of 2025 in the price of industrial metals, as China will come up with some massive stimulus, and that is what our expectation is. So I'm very bullish on industrial metals for this year. Coming to the second part of your question, oil and gas. Oil market currently is tight, okay, with whatever is going on, because OPEC did not increase the production of crude oil. Uh, oil prices are continuously moving up. But Trump is focusing on new exploration projects, new drills. I don't know what he's going to come up with, but till the time the new supply is not coming in the market, markets will, in a first half, will remain tight. And second half, if the prices goes up, the supply again starts to catch up. So I'm not very optimistic about the overall outlook of oil for the year 2025. Maximum upside for the Brent should be 85, and maximum downside should be 65, 68. But the upside should be capped, because with the higher prices, the supply will come and OPEC will be forced to come up with more supplies. Natural gas, on the contrary, looks relatively much bullish and better commodity, at least for the first quarter of 2025, because of the cold winter in US, Europe, the supply concerns of the European gas, the expectation of US exports to Europe going to shoot up. These are the reasons for us to remain bullish on gas. Gas prices can shoot up by 10 to 15% in the first quarter of 2025, but crude doesn't look very bullish.
Is not very bullish, but when it comes to industrial metals, you expect China to come up with stimulus measures in this calendar year, which could perhaps boost demand for most industrial metals. Mr. Shah, thank you so much for taking your time out and speaking with us here on ET Now on a whole host of issues, and giving some words of wisdom from your 2.5 decade experience. Thank you so much for joining us. We'll slip into a short break. That's all the time we have on this edition of Commodity Central, but you don't go anywhere. More news and updates coming up on the other side of the break.